Welcome to Talk Tickers, the briefing built to summarize the critical signals emerging from corporate earnings calls. You are about to get the rapid synthesis of the Mattel Q3 2025 results, delivered after hours on October 21st.
Our mission today, well, it centers entirely on one crucial conflict. We need to unpack the significant headline miss that really hammered the stock right after the bell, and then contrast that negative reaction with management's unwavering confidence in the full-year outlook. You know, the divergence between Q3 reality and Q4 expectation, that's the signal we are chasing here.
Okay, let's start with the pain points then. The immediate market reaction was negative, right? It sort of confirmed the disappointment reflected in the numbers. For you, the listener who just wants the snapshot, Mattel missed on both the top and bottom line.
That's right. Net sales declined 6% year over year, or 7% if you adjust for currency changes, down to $1.74 billion. That missed consensus estimates by, well, nearly $100 million, so pretty significant miss on the top line.
And the profitability side suffered even more, it sounds like.
Yeah, it did. Adjusted earnings per share, or EPS, came in at $0.89. Now, that was a serious miss, falling short of analyst targets that averaged around $1.06, give or take. And compounding the issue, the adjusted gross margin compressed by 290 basis points year over year.
Wow, 290 basis points.
Yeah. I mean, think of that as profitability dropping by almost 3 full percentage points. It landed at 50.2%. Lower sales and lower margins, that's the recipe for volatility right there.
So lower revenue and less profitable sales. Okay, the market's reaction is pretty understandable then. Now, let's unpack this Q3 performance because management insists this was simply a, let's say, logistical hiccup, not really a demand issue. Where was the epicenter of the stress?
Undeniably North America. That was the main headache. Gross billings in the region declined a massive 10% year over year.
10%, okay. And management pinned this sharp wholesale decline on what they called industry-wide shifts in retailer ordering patterns. For those of us who don't, live in supply chain logistics, what does that timing shift actually look like?
It's crucial, actually. Retailers decided to shift away from direct import orders. Normally, that meant they'd take ownership of the product months ahead of the holiday season, directly from the factory overseas.
Right.
Instead, they opted for domestic shipping. So this means Mattel had to handle the importation, the warehousing, basically hold the inventory risk themselves, and they only ship the product to retailers later in the calendar year.
Okay. That shift explains the wholesale miss perfectly then, because the orders were simply delayed, pushed out. Right. But here's a critical counterpoint management kept stressing, right?
Yeah.
Despite the drop in wholesale shipments, consumer point of sale, or POS, demand for Mattel products actually increased across every single operating region, including the challenging U.S. market. So the consumer is still buying the toys.
That's the core of management's thesis. The demand is robust. The shipment timing was the issue. That's what they're sticking to.
But wait a minute, though. If POS demand is actually increasing, why would major North American retailers suddenly decide to shift that inventory risk onto Mattel by moving to domestic shipping? I mean, doesn't that suggest they are maybe nervous about the current state of consumer spending, or perhaps worried about inflation hitting the customer later in the year? Is this really just a logistical issue, or are retailers maybe signaling some caution about pricing and end market demand?
That is absolutely the right question to ask. Management, well, they maintain it's purely logistics. It gives the retailer more flexibility in a period of, economic uncertainty. But if we follow your thinking, what it really highlights is Mattel's competitive moat, perhaps. I mean, their operational scale allows them to absorb this nervousness, handle the importing, and hold the inventory domestically. Smaller competitors simply can't offer retailers that level of flexibility or absorb that kind of risk. So this ability to pivot might actually allow Mattel to structurally gain market share over time.
That reframes the challenge entirely. Not maybe as a failure, but as a strategic flex of their supply chain muscle in a way.
Okay, speaking of strength, if North America was the problem area, where did the company find growth then?
Internationally, yeah, the story was much better. Total international gross billings increased 3% on a reported basis. That was driven by 3% growth in the AMIA region, that's the Americas, Middle East, and Africa, and an even stronger 11% growth in Asia Pacific. So the international business is clearly the stabilizer right now.
Okay. Let's look at their IP engine, which, drives everything for them. What product categories showed the most resilience?
Well, the strength really came from their anchor IP. Vehicles grew 8%. Hot Wheels is on track for an astounding 8th consecutive record year.
8th year?
Yeah, it's incredible. And action figures, building, games, and other categories also grew a healthy 11%. So this proves the diversification beyond just the legacy powerhouse names.
Okay, and where did they see weakness then? Dolls declined 11%. Now, this was primarily due to the natural post-movie softening of the Barbie franchise and Polly Pocket as well. However, management was pretty quick to note that growth in Monster High and American Girl provided a strong offset there. The biggest drag, though, was infant, toddler, and preschool. That was down 25%, mainly from declines in Fisher-Price and also some planned exits of specific product lines. So the narrative here is really a purposeful mix shift toward higher margin, IP-driven collector and action segments.
Got it. Okay, let's circle back quickly to that margin erosion, the 2.9 percentage point drop you mentioned. What factors were overwhelming those cost savings they're trying to achieve?
Right. The decrease was primarily due to, well, unfavorable foreign exchange movements, general inflation, those persistent tariff costs, and also higher sales adjustments. Mattel is fighting back hard, though, through its Optimizing for Profitable Growth program. They generated $23 million in Q3 savings from that, and they're targeting $600 million in total savings by 2026. It's an ongoing effort.
What about the pricing actions they took earlier this year? The ones meant to offset those tariff and cost pressures. Are those finally flowing through the income statement?
Not fully yet, no. The company implemented those pricing actions back in Q2 and early Q3. However, because of their inventory cycle times, the full impact of those tariff-related price increases will only really hit the profit and loss statement more meaningfully toward the fourth quarter. They did stress, though, that consumer demand hasn't seemed to slow down because of those price increases, which, that's a great sign, if true.
Okay. And since they absorbed that domestic shipping risk, let's check the balance sheet. Does that massive inventory increase look like a red flag or more like a strategic maneuver?
It really seems to be the latter. Inventory did increase 10% to $827 million, but this is directly attributable to that timing shift we discussed. Mattel is now holding inventory that retailers would have held under the old direct import model. And crucially, they stated that retailer inventories are actually modestly lower year over year, which, sets the table for strong replenishment orders throughout the holiday season, assuming demand holds up.
Right. That inventory rationale leads us straight to why management is so confident then. They seem to be staking the entire year on the assertion that Q3 was simply an inventory air pocket, one that has already begun to resolve itself.
Their confidence is, well, absolute, it seems. Management reported that U.S. retailer orders accelerated significantly since the start of Q4. So the full-year thesis hinges entirely on that strong holiday sell-through actually materializing.
Let's just pause on that guidance for a second, though. The Q3 result was, let's be honest, a massive miss compared to expectations. Yet they completely reiterated the full year 2025 guidance. Net sales growth of 1% to 3% in constant currency and adjusted EPS between $1.54 and $1.66. To achieve that, Q4 needs to be, heroic. That's a huge operational hurdle they are betting on clearing.
It is, and their betting chips fundamentally are their intellectual property and that entertainment pipeline they're building, this long-term strategy of expanding the toy core into a major media engine. That's really what anchors their confidence, I think.
And they made some highly calculated moves in Q3 on that front, securing global licensing rights for the K-pop Demon Hunters franchise across dolls and action figures. That signals a pretty determined effort to capture the rapidly growing Gen Z and Gen Alpha demographic, where maybe legacy toy companies have traditionally lagged a bit.
Absolutely. And critically, at the same time, they renewed their multi-year agreement for the essential Disney Princess and Frozen franchises. That proves they remain the primary partner for major Hollywood IP, which is core to the business.
Right, they're covering both bases. Their internal content slate is equally interesting, too. It seems to showcase their ability to monetize their deep catalog. They announced the development of 2 new premium live-action scripted TV series, one based on the Shawnee doll line and another based on the iconic Magic 8 Ball franchise. That Magic 8 Ball one is slated to be directed by M. Night Shyamalan and written by Brad Falchuk. Pretty big names.
Yeah, and this isn't just about celebrity names, right? It's about proving their ability to spin deep, latent catalog IP, like the Magic 8 Ball, into high-margin media assets. It's about establishing a durable, non-toy revenue stream. They also confirmed their self-publishing digital game strategy is moving forward, with 2 games expected to launch in 2026. This just reinforces the idea that Mattel really views itself as a fully integrated entertainment company now, not just a toy maker.
Okay, so we have this massive dichotomy here. A Q3 miss leading to a, 5% to 7% share drop after hours, versus management's absolute insistence that the consumer's healthy, the inventory is placed strategically, and Q4 orders have already accelerated significantly. The market is clearly pricing in massive execution risk for the holiday season. Which brings us to our This Is Not Financial Advice segment. And I must state clearly, again, that this discussion is for entertainment purposes only. It should absolutely not be considered investment advice. Please consult a professional before making any financial decisions.
Duly noted. The tension between the Q3 numbers and the Q4 promise is palpable.
Okay, so here's the strategic angle, purely speculative, of course. The market is currently punishing Mattel for the margin dip in that Q3 timing miss. But if management is even half right about the significant acceleration in U.S. retailer orders, then maybe the stock is momentarily mispriced because the long-term thesis, strong IP, growing POS demand, remains intact. So the outrageous but plausible bet here is on a rapid resolution of this uncertainty. You could theoretically leverage the current market pessimism by betting on volatility and a quick rebound. The expectation would be simple. As soon as the weekly point-of-sale data starts confirming management's thesis, perhaps driven by that unrelenting demand for Hot Wheels and the need for retailers to replenish that low inventory, the market might forget the Q3 margin jitters pretty quickly and bid the stock back toward its pre-earnings levels maybe within the next couple of months. It's essentially a volatility play, betting that timing risk has already been successfully navigated.
That is certainly an aggressive stance. It's betting heavily on the consumer showing up strong this holiday season and really trusting Mattel's operational pivot and execution in Q4.
It absolutely is. High risk, potential reward if things break right.
All right, so to recap then, we covered Mattel's Q3 earnings, noting the massive wholesale shipment challenge in North America and the corresponding margin pressure. But we really focused on the crucial counterpoints. That strategic resilience driven by Hot Wheels, the strong international growth, and the really critical reaffirmation of the full-year guidance based on those supposedly accelerated Q4 orders.
So what's the final provocative thought we should leave you, the listener, with today?
Well, I think the current situation really forces us to consider the long-term structural landscape of the toy industry. If trade uncertainty and these kinds of retailer ordering shifts continue, how much of a permanent market advantage does Mattel's sheer scale and supply chain capability actually provide? Their ability to absorb the risk of shifting from direct import to domestic shipping. How does that compare to smaller players? And could that operational moat actually allow them to permanently gain market share in the U.S. as the environment eventually normalizes? That, I think, is the structural signal that matters most beyond just one quarter's numbers.
That's an excellent context to end on. Thank you for joining us for this deep dive.
Absolutely. Till next time.